Ladies and gentlemen, welcome back to another live stream. Today it's very important because the Fed chair will be speaking from Jackson Hole. Now, what is Jackson Hole? How is the Fed chair speech actually going to affect the markets? That we will discuss in today's live stream. But the first thing is first, make sure to leave a like. Let's get this live stream to now 50 likes. I believe there is 77 people tuned in. I'm going to quickly I'm going to quickly check the live stream if it's actually working, because last time, guys, I had an incident where the microphone wasn't actually on, and that basically for like half an hour I was speaking without the microphone. So I've learned from that lesson. Let's check the live stream. The microphone. Perfect. Everything is working fine. That's awesome, guys. Again, let's smash up the like button. Let's get it to 50 likes. Now, we're going to jump into the Bitcoin charts, right? So the Bitcoin chart, it's looking pretty interesting. So there's a couple of factors, a couple of things that we want to discuss. Of course, we're going to talk about inflation, interest rates. Then we're going to look into Jackson Hole, why it's so important, and how it can potentially impact the markets. Now, I'm going to look at Bitcoin. And while I'm doing so, guys, I'm going to share the live stream in Telegram. Now, if you guys aren't in my free Telegram channel, you can join using the link in the description below. It's awesome. I share my videos there. Sometimes I share my TA. It's completely for free. And there's about 6,500 people, which is absolutely crazy. So if you're not in already, I would definitely recommend joining over there. And guys, if you want to be trading Bitcoin or cryptocurrencies, I have two of my preferred exchanges also in the description. Of course, if you join using the Bitflex link here, you'll be able to participate in future giveaways. And if you use the Bybit link, then you'll be able to get a nice deposit bonus. So while I'm sharing this live stream on my Telegram channel, I'm going to discuss, right? I'm going to discuss what is happening at the moment for Bitcoin. Now, we're seeing a bear flag on the 4 hourly, and things are not looking too good. So I'm just typing in the Telegram, join us live for the Fed chair's speech. Now, this speech is going to cause a lot of movement. I mean, it's going to surprise you. Maybe not so much on Bitcoin, although I do think it will, but more so on the stocks, on the traditional stocks. The S&P 500 is pretty volatile, right? It's not like how it used to be like for the past couple of weeks. It's actually very volatile, especially on this specific candle here. And we've already went up to around 4,460. Now we're trading around 4,400, but I do believe we'll see another momentous move in the Fed chair speech. So I'm going to jump into that also. There's a lot to explain. It's really going to be exciting. So stay tuned until the end, because I hope we're going to be able to look at it live. I have it over here, so we're going to be able to watch it live from Kansas City Fed. I'm going to explain what Jackson Hole is and a bunch of other stuff. So make sure to share this with your friends that like crypto or like stocks. Don't know what Jackson Hole is, just like trading in general. So make sure to share this live stream with your friends and leave a like. That would be much, much appreciated. Speech. And boom, it is up on Telegram, ladies and gentlemen. And leave in the comments below, how is your day going? How is summer? I want to know. I'll check the chats very, very soon. Okay, so let's jump into Bitcoin. The first thing that we want to do is do some Bitcoin TA, right? And the thing is, the Jackson Hole Fed chair speech is going to be in around 15 minutes. So until then, we're going to look into some Bitcoin charts and see what is going to potentially happen after the Fed chair speech. Now, as I said, we're in a bear flag on the 4 hourly time frame. This is not great. Right, if you watch my Bitcoin technical analysis video yesterday, we were looking at this macro chart with Natalie, right? So we held this very important $25,200 level of support. And on Crypto Banter's show, I believe it was last week now. Honestly, I've lost track of time. It's so funny. I'm like checking the day of, it's 25th of August. Wow, it's crazy. I'm back to school in around a week now, so not excited for that. Hopefully, I'll be able to do live streams like this during school time. I'll find a way. I'll find a way. But we held this $25,200 level support, and that's important. In Banter's live stream, when I was talking with Da Vinci, the tilted head and shoulders, or the three drivers pattern, that had a target of $25,000, and honestly, Da Vinci called it very nicely. We did break down to that level, and I was talking about the support line. If we were to break that, then Bitcoin would have a fall, and we did. and now we're trading at around $26,000. So that is Bitcoin's outlook at the moment. At the level that we are in currently, there is not much volume. Well, there is, but if we go a little bit lower to like $25,200 and below that, there's not much volume until around $17,000. And what happens is when there is low volume like this, Bitcoin tends to, well, when it drops or if it drops, it tends to drop at a much faster rate because, of course, no volume, no demand means the asset will fall in price. So that's the thing that concerns me at the moment, but it's super critical that we hold this $25,200. Otherwise, it could get worse. So this is Bitcoin's outlook at the moment, and we still have around 10-15 minutes until the Jackson Hole speech. So might as well explain what Jackson Hole is. Now it's pretty interesting, right? So Jackson Hole, it's a very big and important economic conference, if you want to call it a summit. It's a 3-day conference. And what happens here is the top economists, the top policymakers all come to this particular conference. It's called a symposium, and they discuss about the country's, the United States' future, its economy, its future, and what's going to happen. And usually a lot of big decisions are given within this conference, right? We see a lot of stuff happening because it is so important and filled with a lot of A-list celebrity economists and policymakers. The media is not really allowed to, enter in and document about what's happening. So the only chance we really have is if they catch interviews or the Fed chair speech. Now, why is this specifically very important? Now, this is very important because, first of all, the Fed chair doesn't really go to these symposiums. It's not quite often that he actually goes to these symposiums and delivers a speech. It's very rare. And whenever he does, a lot of investors, a lot of analysts are always keen to watch it and observe what he says. Now, I'm going to jump back into this explanation from Barron's. Right, I couldn't speak. We're going to see what the title of this year's symposium is. It's called Structural Shifts in the Global Economy. Now, this is a very vague but very important title. Now, we know that because of interest rates, inflation data recently, the prediction is that the Fed chair will most likely speak or hint or speak in a tone of increasing interest rates, right? Tightening monetary policy. And if he hints anything like that, then I'm expecting traditional markets, a lot of analysts are expecting traditional markets to take a dump towards the downside. Take a dump, no. Take a, well, crash towards the downside, right? So, and that support level would be at around, I don't think it's going to be that big, right? Honestly, it's not going to be huge in terms of a fall in price. But if we were to drop, right, I think that 43,050 is a good level for the S&P to drop down to. And that's around a 1% move. Now, a 1% move to you to crypto degens may not sound like a lot, but in reality, it is actually quite a lot for the stock markets. So a 1% move towards the downside is possible, but to note, we are at good support, and it looks like the S&P is currently holding it. Of course, this may very well change in the upcoming minutes, according to the Fed chair's outlook and what he delivers in his speech about the current economy. But other than that, the S&P is at a good level, and we must hold it. So jumping back into Jackson Hole. So as I said, this title is very broad, but it's very important. Now, the expectation is that the Fed chair will speak about tightening monetary policy. And anything like that is mentioned, it's technically bad for the traditional markets. However, we know, right, from our years of experience in crypto, that Bitcoin does not always like to follow traditional markets, and it kind of likes to do its own thing, right? So because it kind of likes to do its own thing, we may not see the dump, right? Something interesting may happen, and I'm going to explain what that could be, but I'm just going to check on the live stream if it's all good. Yeah, it looks good. But guys, let's smash up the like button. Let's at least get this live to 200 likes. That would be very much appreciated. So if you can just take 10 seconds, 5 seconds, even 3 seconds, just to leave a like on the stream, that would be absolutely amazing. It's completely free, and it would mean a lot to me. So if you can go ahead and do that, that would mean the world. Now, Jackson Hole, right? Back to Jackson Hole. The topic is vague but very important. And if he says anything about rapidly tightening monetary policy, then that's going to be bad. So during the conference, the Fed chair is expected to have dinners with high-profile people, bankers, policymakers, economists, etc. And of course, during these talks, there's a lot of things that are decided. There's a lot of important things that are discussed. And if these discussions are based on increasing interest rates, which are, by the way, currently at a 22-year high. 22-year high. That is absolutely crazy. In the last 22 years, the interest rates has not been this high. Now, why are interest rates so high? Because when they increase interest rates, to those of you that may not know, they're trying to drop inflation, right? They're trying to drop inflation so that stuff, when you buy, when you go to the supermarket, when you want to purchase your milk, when you want to purchase your bread, or you want to purchase your iPhone, that is cheaper, right? So it's not at a cost where you can't afford to pay. Now, why do they want to do that? And why is increasing inflation bad for the economy? Now, if I don't have enough money, well, or if this iPhone is too pricey, if the bread in the supermarket is too pricey, then I'm not going to be able to buy stuff that, let's say high order goods. I'm probably not going to go ahead and buy a car, or I'm not going to go ahead and purchase a house. So those are called high order goods or high order services. I'm not going to be buying those or using those services because simply I need to ration that money and spend it on bread. I need to spend it on that carton of milk. I need to save up more. And when I do this, I'm actually putting less into the economy. I'm not spending, I'm saving, and I'm spending less in the economy. And what happens is if you do not spend, or if the economy doesn't turn in a country, then well, that economy faces a recession. Now, to put Bitcoin and the stock markets into perspective, people, right, big investors during inflation, during high inflation, during things that are too expensive, investors don't tend to invest in the stock market either, or invest in Bitcoin too, because it's not a necessity. So because of that, we usually see a drop down on the S&P 500. We see a drop down on assets like Bitcoin, and we see an increase in goods such as gold and silver, because they're hedges to inflation. That's what they're known for. So I hope that explains it. I just wanted to give that quick explanation to some of you that may not know why this is so significant, why it's important information to know. If you guys can let me know if the stream is good, if the audio is good, if the video is good, that would also be very much appreciated, and make sure to leave a like too. Now, this conference, this summit, Jackson Hole, it's been something that's been going on since the 1980s, and that's perfect, right? By the way, 5 minutes left till the Fed Chair speech. I will be jumping into the live very soon, so make sure to stay tuned. It's going to be very volatile out there, it looks like. So again, stay tuned. In about 5 minutes, the Jackson Hole Fed Chair speech will be starting. Now, this has been going on since the 1980s, and it's a pretty prestigious event. Again, a lot of very important policymakers join. It's pretty big. So this thing that we're about to witness is kind of historic because the Fed chair doesn't usually join these events as a speaker and doesn't really give a speech from the event itself. So this is going to be very, very crucial. Now, I have a small short position open on my personal side. It's risky. That's why I didn't share it. It's 2x leverage, low margin, but I don't like how the market is looking at the moment. I really do not like it. So I do think if we do not hold this level of support, Bitcoin can crash towards the downside a little more. And if that happens, well, it's not going to be nice. So yeah, I have a small risky trade open. I usually do not like to trade news events, but this one, a lot of analysts like it's just a bit obvious. It's a bit too obvious that he's going to mention stuff about tighter monetary policy. Of course, we can never know 100%, but if he does, then the traditional markets are expecting a drop towards the downside. Bitcoin may not follow that. It may follow that. Right? We can't know that for sure. The only thing that we do know for sure is that if big banks collapse, Bitcoin increases according to its history. But other things, not really certain. So I'm going to quickly refresh this Kansas City Fed YouTube channel because that is, oh, there we go. Okay, so let's switch into this. I'm going to mute my mic, but I'm not sure if it's started yet. Oh, started. Hold on. Let me mute my mic.
Last year's Jackson Hole Symposium, I delivered a brief, direct message. My remarks this year will be a bit longer, but the message is the same. It is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably.
Okay, I'm going to cut in. Now, the things he's saying, it's, again, as we talked about, tighter monetary policy, increasing interest rates. So this is bad for the markets.
Outlook and the uncertainties we face as we pursue our dual mandate goals. I will conclude with a summary of what this means for policy. Given how far we have come, at upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. The ongoing episode of high inflation initially emerged from a collision between very strong demand and pandemic-constrained supply. By the time the FOMC raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. While these two forces are now working together to bring down inflation, the process still has a long way to go, even with the more favorable recent readings. On a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022 and declined to 3.3% as of July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since early 2022. Headline inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome, but 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We can't yet know the extent to which these lower readings will continue or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the three broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown, and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress.
Okay, guys, I'm just going to jump in here and give you some of my insights so far from what he's saying. Now, as we predicted, he is talking about a tighter monetary policy. And guys, for the ones that have just joined the live stream, if you can like, that would mean the world. So please do leave a like on the stream. So he's talking about tighter monetary policy. Look, overall, the US economy is not good, right? There's a lot of factors that we can discuss here for the entire day. However, the economy is not good. It's just overall, fundamentally, the US economy is not at a great place. Now, from what he's saying, you can basically get the gist of that. If we have a quick look at the markets, the S&P has started to see a fall towards the downside like we spoke earlier on, and Bitcoin it saw a small dump right now. It's nothing too big. So let's go ahead and jump back into what he's actually saying, and then after a few minutes, I will start sharing my thoughts so far on what he said. So let me unmute here. Let me mute myself.
Over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well. And we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest-sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor-intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's symposium, the 2-year real yield is up about 250 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened, and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend, and recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54, and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
So, ladies and gents, that was the Fed Chair's speech. Now, I'm going to give you my personal breakdown of everything that is said. Now, it looks like the S&P 500, right, it was a buy the rumor, sell the news situation, because, well, it was the opposite of that, because the S&P is starting to see a small pump towards the upside back again. Again, as I said in the start of the stream, it was very much expected that the Fed chair was going to speak about tightening monetary policy. So this was already expected by a lot of analysts. So I'm not that surprised that we didn't see a big drop towards the downside. Again, I mentioned also that I think maximum it would be a 1% move towards a downside, but as I said, it was already very much predicted. Bitcoin not doing much. We're at the same place as it was before. But I will give you a breakdown because the stuff he said is actually very crucial. Now, the first thing I want to talk about is, look, they have a firm 2% inflation goal. Firm 2%. They want to get down to 2%. And he didn't hint anything saying that we will stop raising interest rates, or we will stay constant. He just said that our goal is 2% inflation. And what does this mean? To get to that 2% inflation, they will most likely increase interest rates. Now, that would mean that the interest rates will increase above a 22-year high, that which we're at right now. And that is basically historical. I mean, it's something that probably we won't see in the upcoming decades. It'll be a very long time until we see something like this again. It's just a very historical moment in terms of interest rate levels. So it looks like that they will continue to increase interest rates. Of course, this will not be perfect for traditional markets, but increasing interest rates usually tends to put bigger banks in financial trouble, if of course their holdings are more based on short-term interest rate bonds. I think after the SVB situation, a lot of banks did remodel their financial structure in terms of their holdings, in terms of their risk management. Yes, during SVB was an anomaly for the banks. They did hold a lot of short-term interest rate bond positions, and no one expected that interest rates would hike this much before COVID, or during the COVID time, if you want to say. So that is why SVB went under. That is why First Republic went under. That is the main reason. So I honestly think that in all of honesty, I think that banks have now better risk managed, and they're not holding these these bonds that would cause them to go in more further financial trouble. But again, higher interest rates are not good for banks, because of course they have to pay more interest to the people that deposit their money to the bank, right? So it's not a great thing for banks, and that of course is good for Bitcoin, because we know from Bitcoin's price history that once banks go into trouble, Bitcoin does see a push towards the upside. So let's end off quickly with Bitcoin analysis, because, right, the Fed chair speech is over, but we will have a look at Bitcoin. So Bitcoin, again, same place as it was before. I would highly recommend watching my video from yesterday. So go after the stream is done. Go back to my video yesterday, because there I spoke about BRICS. Now, BRICS Summit, I believe it just ended today, or ended yesterday, and very important stuff, very important updates are coming from there. And those important updates link to the strength of the dollar, link to the strength of the United States economy. And if this continues, then Bitcoin can see a push towards the upside. So I mentioned a lot of very important information on my previous video. So again, after the stream ends, jump into the last video I made, and make sure to watch that. It's important, right? So there I gave a bit more of an in-depth analysis anyways. So in terms of the short to midterm, what do I think is happening to Bitcoin long term? I think that we will range, right? I think we will just range until 2024, until the halving comes, until the ETFs are approved. That's honestly what I think will happen. This support is very important. If we go below that, then it won't be great. I'll just say that it won't be great. Hopefully we will trend consolidate around here, and then towards Q1 of 2024, we can make it above this $31,000 trend line with the halving, of course. But other than that, very, very short term, we have a bear flag on the 4 hourly time frame. On the weekly, it looks like a reversal candle, but it all will depend if we break above $26,600 and begin trading above. If we don't and we break towards the downside from the support of 25,800, then we can see Bitcoin come back down to $25,200 once again. And I wouldn't be surprised if that happened. As I mentioned, I have a very small short position just in case something like this happens. And if that drop does happen, I will take profit and see what happens, because again, this level of support is very, very crucial. Now, in terms of more economic updates coming up. Jackson Hole is continuing over the weekend. I believe a few more FOMC members will be speaking, but it's not going to be. Look, the Fed chair speech was the one that everybody really was on the look for. So if anything crazy happens there, of course, I will update you on my free Telegram channel. I'll update you on Twitter too, which you can follow me on Twitter and turn on the notifications there as well. If something crazy happens, then of course I will make a video. So turn on the notification bell for the channel. Now let's end off with the crypto markets overall. Let's refresh because I haven't refreshed it in a while. Um, yeah, I mean, it's pretty much the same since yesterday. A lot of altcoins, as I said, in my opinion, are on very big fire sales. I am accumulating. Let's see. All of my hope is dependent on 2024 quarter 1. Once the halving comes around, if Bitcoin can't make it back up near all-time highs, at least during the halving situation, then that's when all hope is lost, in my opinion. I'm being very honest here. But I really believe in Bitcoin. I believe in the technology. I believe that at some point, whether that's in 10 years, 15 years, it will get adopted. So that's why I'm very long term. So I don't really care too much about small movements in price. I do always accumulate with money that I'm not afraid of losing. And yeah, that's my long-term strategy. So yeah, that is pretty much it, guys. So thank you very much for watching the stream. I hope you enjoyed. I hope you enjoyed the stream itself. The Fed chair spoke about tighter monetary policy, that they're most likely, didn't say we're going to increase interest rates if I'm not wrong, but that's what it most likely will happen to get to that 2% inflation target. So that is what will be coming up in the upcoming FOMC statements. That's what it seems like. So guys, again, thank you so much for tuning in. Hopefully you'll have a beautiful day. And everyone, I will see you all very, very soon. So guys, take care. Have a nice day. And yeah, bye-bye.